Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Joyce, managing director on Nasdaq's market intelligence desk. We're going to review levels to watch in the Nasdaq 100, and of course, we're going to cover Fed policy, what's happening with rates, and of course, intervention with the Japanese yen and what that means for the dollar. Brian, it's great to see you as always. And September, as we've been talking about all month, is living up to its reputation for being the most volatile month of the year.
Sure.
We got the Fed meeting out of the way. We saw the reaction. You know, stocks are trading both up and down. There's a lot of volatility in the market. You know, glad we got the FOMC meeting out of the way, though.
Yeah. So yesterday was the FOMC. We've seen a lot of activity related to the Fed, interest rates, inflation data in the last month, really since mid-August. That has really been driving the market to the downside. We had a nice rally off the June lows of about 24% for the Nasdaq 100 to the August highs, and then Jackson Hole, we saw much more hawkish. Fed Powell, we kind of saw a little bit of that as well as yesterday, or I should say, quite a bit of reinforcement of that hawkishness by Powell. And in between that, we had last week's CPI data, which was followed by pretty extreme sell-off in the markets, which was the concern of the core inflation, the stickiness of rent and new cars and services.
Yeah, and it's broad-based too. It's not like it's specific to one sector or the other. But let's take a look at some new levels to watch in the Nasdaq 100, because we are kind of hitting some key areas here.
Yeah, so you can just see here, if I can zoom in a little bit, we bottomed, as we noted here, back in mid-June. We did have a rally in mid-August that kind of got above those June highs, but it was unable to hold. And the first break of those June highs was on August 26th when we had Jackson Hole. The next big decline was last week. We had to see this large gap down here following the day of the morning of the CPI release, much worse than expected. And then yesterday's FOMC was a pretty strong day to the downside as well. So we're seeing we've broken some expected or some hopeful support levels, maybe is a better way to put it. We now below us on a very near-term basis. I'm looking to that horizontal purple or a dotted line there around 11,357, 358. That's a price gap. I'd call it a very minor support. And then really the bigger level to look to is those June lows around 11,000, 1137. That would be a key level that a lot of eyes are on. We are seeing some of those bigger, larger cap names within the Nasdaq 100 beginning to already break below that level. So I don't know if that's a sign of things to come. Mm-hmm. But given what the commentary has out of the Fed, yesterday Powell reiterated that they're determined to hit that 2% level with CPI, and says that it will be enough, which was kind of reminiscent of what we heard 10 years ago this year in July of 2012 when Mario Draghi from the ECB used very similar words to say it'll be enough to get rates down, actually.
I can't believe how fast those 10 years have gone and what has happened, not even just in the markets, but globally. Let's talk about rates for a moment here, because from what I heard, Powell's strategy has not shifted. It sounded pretty hawkish to me.
Absolutely. So very hawkish commentary. The thing is, as we had noted a couple of times already, at the end of that July FOMC, when he said we're going to be data dependent, the market, at least some part of the market, seemingly took that to mean that maybe they were going to be a little bit more flexible and potentially that dovish pivot would be sooner. And as you can see, what we're looking at right here is the rates curve at the end of July, which was a day or two after the FOMC, versus the rate curve right now. So you can see yields across the entire curve have gone up dramatically, driven by the belly of the curve, the 2, the 3, and the 5. And if we look at just the individual rates, the 10-year yield, this is a long-term monthly period chart. This month and last month, we've seen, it's risen over 100 basis points since the end of July. It's broken above the highs from 2018 and the highs from 2013 in that the 3.25% range. We saw yesterday that the dot projections out of the FOMC is now looking for 4.5% to 5% for the Fed funds rate. So that's a pretty dramatic move by the end of 2013. And this year now is going back to a longer-term look on a quarterly basis. That secular move the last 40 years, rates have been trending down on the 10-year yield. And in the last 2 quarters, we've broken the downtrend, and we're now breaking above that 3.25 range. So on this longer-term look, this looks like maybe we're certainly in for a longer-lasting move, higher rates for longer.
You showed me a really interesting chart this morning when we were going over our notes regarding global debt and yields. And
sure.
I think out of every chart you and I have ever covered, this probably stands out to me the most.
Yeah, so bonds have really been a big, along with FX, I guess this has really been quite a year. And so the total dollar amount of negative yielding debt was above 18 trillion in 2021, and we're now down less than $2 trillion. So that's what we're showing here on this chart. It's fallen 90%. So that really is telling, a lot of that debt is on the balance sheets of central banks, of the Bank of Japan, so to speak, the European Central Bank, and it really has an impact to other asset classes, maybe growth versus value as well. If rates are going to be higher for longer, then maybe those larger cap, higher multiple stocks would be something that could see a greater negative impact from that, as well as a lot of different asset classes. What's going to happen to the bonds overall, other types of bonds, commodities, et cetera.
Right, and to your point, it does feel very 2012-ish, right? Because once you start to see this intervention, like we're seeing with the yen and how that has impacted the dollar, it just feels as if should we get a significant global debt crisis, right? Should we have any collapse in the banking system? There's a lot of pillars here that can kind of all drop at the same time when you think about it from that perspective.
Correct. The collapsing of the global banking system, those are pretty extreme
I mean, that's
things.
what we heard about in 2012 when we were talking, even when you think about Greece, when you think about Turkey, when Draghi had made those comments,
Sure.
That was the narrative that
trying to
had
save the
markets,
European Union.
nervous.
Yeah, absolutely. And so, right. And so, back then in 2012, those comments really were more about stabilizing the European Union, and especially those countries within it that were having a sovereign crisis with their with their debt, I should say, their national debt. So, we are seeing some very dramatic moves in the FX markets this year, and it's probably going to have impacts on the global economy for years, not just in the shorter term. So the U.S. dollar, the dollar index, which is heavily weighted to the euro, having its biggest year on record going back to the late 1960s. I think that's 1967. This is using Bloomberg data. If we look at the Japanese yen, it's depreciated 25% plus this year,
right.
Worst on record going back to the early 1970s. And so, we did see some intervention today. So on the long-term basis, this is a quarterly period chart of the yen. We could see last quarter ending June, there was that breakout from the highs previously set in 2007. So we're looking at roughly a 15-year breakout. So this to me is quite telling and says the very longer-term trend for the yen is going to continue to weaken. If you wanted, though, really shorten up that time frame and really kind of look at what happened yesterday or in the overnight, there was some intervention to try and stabilize the yen, which had really been, as we just noted, depreciating quite a bit in value. So I think it's probably a short-term measure, unless there's something that's more dramatically done. Like maybe they decide to reset the peg on the long-term rates, which is now roughly 25, 26 basis points. But once they start that process where maybe if they were to reset it higher, then maybe the market just continues to push them further.
Well, I mean, if we see that come back more in balance with all the other outliers the market's contending with, that should, in theory, be good for stocks, right? If you see it come more back in balance, I mean, you don't want the dollar that high for so long. I mean, it's just going to start to impact earnings at some point.
Right, but the problem is that it's as Powell noted, it's going to be painful to try and fix inflation. So they're going to raise rates. So you have that difference in rate differentials, not just between the United States and Japan, but also between the United States and Europe. Europe is just beginning their rate increases here in July, and I don't think they're going to be going at the same pace as we are here in the United States. So that is going to also be a headwind if you look into kind of trying to slow down the appreciation of the dollar or the devaluation of the yen. Those are other things that you need to consider.
You speak to companies and management teams all day long, clients, traders. I feel like last week and this week, everybody is overwhelmingly negative, almost worried to a point. Are you picking up on that as well? I think really FedEx kind of spooked the market, just considering how many touch points it has in the economy, whether it's shipping, logistics, the different companies that they work with. You can even gauge consumer demand off of what FedEx says. Yeah,
so there's certainly a lot of concern out there. It's not often that you have the the head of the central bank of the United States telling you that he's looking to tighten financial conditions, which if you can read through the meaning of that means he's driving the stock market lower intentionally. So that's certainly a concern. A lot of what has come out of the market as far as price action goes has been on the multiple side, the valuation side. So we've seen PEs come down from the low 20s to around 16, 17 right now, the forward 12-month PE for the S&P 500. The actual earnings for the S&P 500 for this year have only come in about 2 to 3%, and for 2023 they've only come down about 5%. So corporate earnings at the moment are still holding up. I know we've had some cautionary comments from Ford, from FedEx, as you just noted, and that's certainly something to be mindful of. The transportation index, marginally broke its June lows. They kind of recovered there a little bit, but they're trading right around those June lows. I don't know if that's a leading indicator of what maybe the rest of the market is going to do. But from the corporate earnings point of view, that is something that at the moment is still holding up, and so management teams can look to that. So I speak to a lot of financial companies here listed on Nasdaq, and financials next year are supposed to have 13% earnings growth. So and that's higher than what the S&P is looking at. I think it's around 7 or 8%, at the moment. So those certainly can change, particularly for now we're seeing a much more hawkish Fed. But at the moment, corporate earnings, have been holding in.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.